welcome to Money, Money, Money. We come to you this week from New Delhi. And as the smog is finally clearing after Diwali and the air is getting a little clearer, we're also looking for clarity when it comes to personal finance. And this week, we're going to be in conversation with a gentleman from Bajaj Capital. Of course, Bajaj Capital is a 5-time winner of the Financial Advisor Awards in the retail category, including the last year as well. So thanks so much, Sanjiv, as well as Mr. Anil Chopra, for taking out the time and, speaking to us. It's good to be here in Delhi. I have an interesting sort of example. What we're going to do is we'll probably use me as a prototype because we want to get a complete PF plan going for a young working professional. So you can take me, a single individual, a professional as a prototype and build it from scratch. But Sanjiv, the first thoughts, what is your approach when it comes to financial planning?
See, it's quite exciting. It's not something boring or a drab. It's something that you should be excited about because, what it does is that it takes what you have, it multiplies it, and it gives you a much better future than what you have at the moment. So I think, financial planning is a very exciting tool. It's a very exciting way. Don't look at it, look, I'm going to be spending less now, I'm going to be saving, and it's boring, it's drab. So think, look, I'm going to be creating money. I'm going to be generating money at a much faster rate than inflation. I'm going to be richer tomorrow than I'm going to be today. And I'm going to have a wonderful, wonderful time with my money. I'm going to be independent. I'm going to be financially, independent.
Well, that's a great pitch. It's very convincing. The only problem is, Mr. Chopra, and your thoughts on this, that the market is so cluttered. The number of products out there, the number of insurance policies, the number of different types of funds, the different asset classes that are coming up, it does end up leaving one more confused than clear. When you observe a lot of young clients that you interact with, what are the trends? Are people more aware? Are they willing to be more disciplined? What have you observed?
Well, obviously, discipline is something which is required, when you start planning. But I would say prevention is better than cure. That policy applies here as well. That you need to plan well in advance. Now, in your case, because you are just under 30 and you are still unmarried, I'm sure you have plans like, acquiring a big car or having a house of your own in few years from today. So all that you need to make a list of, share them with your planner, and then planner will tell you how much you need to invest every month in what kind of scheme so that you comfortably achieve those goals as and when they arrive.
But that's the problem, Sanjeev, and come in on this because for a lot of young people who are moving around, who are changing jobs, who might actually change careers as well at some point, a lot of the longer term life goals aren't very clearly defined. You do know at some point you want a house and yes, you want to work towards a big automobile, but a lot of they're not very well documented, the short-term goals.
See,
so how to start?
It's not only with you, it's with everybody. Even when you're older, you keep thinking, I'll do this, I'll do that. So that flexibility in your plan will always need to be there. But it's actually very simple. See, financial planning, there may be a lot of jargons, but it's very simple. It starts with what is the most critical thing to you. First thing is your health. So financial planning always starts with health.
Okay.
That's your biggest asset.
Yes.
So can you afford the best treatment for yourself? If God forbid something happens, you should be able to give yourself the best.
Absolutely.
And the statistics is that health insurance is so cheap. If you pay premium for the whole life, even if you get one ailment in your lifetime, you would have recovered the whole premium.
Absolutely.
So at the end of the day, it's not a big amount. So first you start with your health. Then second, you move on to a life insurance. If you have liabilities, dependents, then you have to protect them. At the end of the day, it's life and beyond.
So allow me to ask this blasphemous question. At times, someone like me has wondered, do I actually need life insurance? Because I don't have any dependents, at least as of now. I don't have any liabilities. Would you say that despite that, one still requires life insurance?
See, if you don't have any dependents, then obviously there's no need for life insurance.
Okay.
Life insurance means that there is somebody who's depending on you and you're trying to protect.
Okay, candid admission on money, money, money. Yes, I do not have life insurance, but the experts have verified that as of now, I perhaps don't need that policy.
No, but for you, I would say that you don't need to buy a term at all, but you buy a term with a twist, which is called term with return of premium.
Okay.
So that is giving you back your money if you survive, and at the same time, when you need the life insurance, you're going to have it much more cheaper. And obviously, see, most of the people don't realize, we say we don't need life insurance, but to a certain level, our parents are depending on us.
That's right.
Then most of the Indian parents would have spent a major part of their lifetime earning on educating
on settling
the children,
their children,
or settling their children, or getting them married. So you have to have the responsibility to them.
So coming to the product that you just mentioned, term with a twist, which is term with
the return of premium.
The return of premium. Are we talking about some sort of a ULIP product here?
No, it's not a ULIP product. This is a pure protection plan, but it comes in two variants. One is a pure expense, where you pay 15% service tax. There's another variant, so which is, suppose an example on a crore is about 20,000. So you have another option which is called term with return of premium, where the premium will become about 33,000, but you get the money back. So suppose you have paid for 30 years, you have paid 10 lakh rupees, that 10 lakh rupee comes to you. It is treated as an investment product. So you end up paying a lesser service tax, which is 3.7% at the moment. So GST obviously will change. So you save on the service tax, at the same time you get your money back. It's treated as an investment product. So the claims and the protections available on that product are higher. You can revive the product. You can choose to, after 3 years you can make it paid up. That means that you will still get your money back.
Okay.
If you decide, okay, 5 years down I want to move to a cheaper product. So it has a lot of advantages. It's a new concept. It used to be very expensive earlier, but the new generation TROPs are coming out. So this TROP is actually one of my favorite protection products. It's something I bought for myself, and something, if you can afford it, I'll recommend, and you don't have to buy a big cover. So second becomes the life insurance, and third is the most exciting part. That's the investing.
But before we get to mutual funds, I just want to rewind back and go back to health insurance, because you rightly mentioned, that's where the costs are ballooning and you don't know, anything can happen at any point to anyone. What sort of a health insurance policy should a young working professional go for?
You have to buy the new generation plan which come without sublimit, which give you a choice of the room category you want, and the premium is not much higher.
We're talking 5,000 to 6,000 maybe for a 30-year-old individual?
See, today, let me go extreme. Today for a family, for a 1 crore cover, you can cover the family of 4 at the age of 35 for about 28,000 rupees.
Okay.
And these are high quality new generation plans with very good covers, very good limits. So point is that health insurance is not that expensive, but yeah, let me take your case, single person, a good 10 lakh rupee plan, you should easily be able to get something great between 6 to 8,000 rupees. You personally should look at your young, healthy. So what is the no claim bonus? So is your plan going to double? So by after 4 years, everything gets covered. Now individual health insurance plans has great protection from IRDA. And you have an insurance ombudsman. It's virtually impossible for an insurance company to reject a genuine claim.
Yeah.
And after 4 years, all pre-existing ailments, everything gets covered. So you should buy a plan which gives a very good no claim bonus. So by the time you're in your 30s, late 30s, so your sum insured has virtually become doubled.
Okay.
So
any examples, perhaps some names that come to mind?
For me, one of my favorite plans is Cigna TTK. Maybe because it's one of the newest insurance companies. 3-4 years back, Cigna is a global health insurance leader. So I'm happy about its stability, and this product is the latest.
Okay.
Then on the higher sum assured, I think Max Bupa I'm quite fond of. They have come out with plans with extremely low rates. So, and today also there are some very exciting, like if you are rich enough, you can buy these riders which will give you international coverage. So in case for 8-10 critical illnesses, you can go anywhere in the world. So you can choose the best treatment that is available in the world for those ailments.
So that takes care of the insurance aspect of this. We need to take a very quick break. We come back on the other side and we'll get Mr. Chopra to help us devise a basic investment portfolio for young 30-year-old working professionals. We'll be back in a moment. Welcome back here with Money, Money, Money. We're coming to you from New Delhi and we're in conversation with Bajaj Capital this week. Mr. Chopra, now it's your turn. We've already got the insurance ideas that Sanjiv has shared with us. Now, for someone who's in their early 30s looking at building a sizable investment portfolio via mutual funds, yes, equity is the right way to go, but what are the top 3 or 4 funds that one should definitely have?
Well, who doesn't like to be rich? I'm sure you might have goals like retiring early. You might like to retire at 40 or 45 and enjoy life thereafter. Or maybe plan, a luxury cruise in near future, or it could be business class traveling around the globe. So all these would need, wealth creation ideas. So what we would suggest to youngsters like you is that whatever is your take-home salary, we are not asking your take-home salary to be told here, whatever it is, 30% of that you must be saving every month.
Okay.
And that should be going into disciplined way of investing in public provident fund or ELSS or into diversified equity mutual funds. All these will come handy when you are in your late 30s, early 40s and you are ready to start enjoying the life in a different way. Now, how we suggest to plan is that you must put around 40% in a diversified large cap fund, and large cap fund could include like HDFC top 200 fund or ICICI Prudential top 100 fund, DSP BlackRock top 100 fund. So we started with putting aside 40% in large cap, which are less risky and obviously relatively lesser returns. But now we are getting to the more exotic thing, which is like the mid caps and the small caps and the multi caps and the thematic funds. So that 60% could be divided into maybe 3 SIPs of 20% each. So one could be a mid cap, another could be a small cap, and the last one could be a thematic fund like a international equity fund or a special situation fund or a contra fund.
Give us some examples, some names as well.
Sure.
Yeah.
You see, now value is one concept which is very much in vogue, that currently you invest in some such stocks which are lying low for certain reasons, but otherwise they have a great future. So we have a beautiful fund called ICICI Prudential Value Discovery Fund, which has been doing very well and is expected to do better in future as well. So you need to be putting a SIP in this fund as well. And similarly, when it comes to special situation funds, we have a L&T Value Fund, which is a special situation where the companies which are currently in a situation that the prices are low, but when the cycle turns, they will turn around and they will give good returns. So that is how.
What sort of returns have these funds exhibited in the recent past? I mean, they're not necessarily a benchmark for the future, but just to get an idea.
Yeah, I will start by saying the disclaimer that the past returns are no indication of future.
Sure.
But most of the well-performing diversified equity funds have been in the range of 18 to 25% per annum. But we are not saying that you should expect similar returns in next 10, 15, 20 years. But yes, most experts would tell you that you should expect about 12 to 16% per annum going forward, which would mean that you will double your capital in 5 years. Because remember the rule of 72, so if you get 14% return, your capital will double every 5 years. So 20 years from now, you could be looking at 4 times of the investment which you will be making.
Okay, on that note, another quick break, but on the other side, we'll talk about 2 more asset classes. Fixed income, everybody needs to have a bit of debt in their portfolio, and also real estate, because that is usually a big aim for most young working professionals. We'll talk about that on the other side of this break. Welcome back here with Money, Money, Money. We're in conversation with Bajaj Capital right here in New Delhi this week. So, Sanjiv and Mr. Chopra, I'll now talk about fixed income for a bit. We've discussed equity. The rate environment is changing. Now, you can no longer park your money in an FD and hope to get 8% return. So, again, for young professionals who are willing to take some risk, some debt funds that you think will make sense.
So we would begin by explaining, a 3-year option, which is with the lock-in comes, but it's a very great option if compared to bank fixed deposits, or if you are looking for inflation-beating returns. These are known as capital protection-oriented funds, where 80% of your investment will go into very safe debt instruments like government securities or PSU bonds, etc., and balance 15% would go into some large cap equity. So you also get a kicker of equity, but predominantly you're getting the debt returns, and you can very safely expect inflation-beating returns, which should be the aim when you are investing in fixed income.
So these would be type of balance funds that we're talking about?
These are not exactly balance funds, because balance funds are
primarily equity.
Yeah, they are 65% equity and 35% debt. They are more risky. Now here, when we're talking about fixed income, of course, the risk quotient has to be low, and the liquidity is an important feature which you need to keep in mind, and also the time horizon has to be less than 4 or 5 years,
Sure.
And if you have money only for 3 to 6 months, you could park your money into liquid funds or liquid plus funds, where you can get, 6-7% returns, which is beating the savings bank interest rates, etc.
And what's the tax implication when you withdraw money from these liquid funds?
Well, as far as debt funds are concerned, you need to wait for 3 years to get the
indexation benefit
and a lower rate of tax.
Right.
If you are withdrawing before 3 years, then we would suggest to be in a dividend option, where whatever dividend you earn is completely tax-free and the tax is already paid from it. Otherwise, if you are in a growth option and you withdraw your money before 3 years, then whatever gain you are making, you'll have to pay tax as per your own slab, which will depend upon what your total income is.
Okay, fair enough. So when we are talking about a pure debt fund, then what would the advice be? I mean, there's a lot of talk with the interest rate cycle changing, whether accrual funds are right or duration funds. People talk about these credit opportunity funds, which I suppose are slightly more risky because they invest in corporate paper.
Yeah, you see, now looking at the current situation that we are in, we had an interest rate cut only about few weeks ago, 25 basis points. So in this scenario, investing in duration fund doesn't make much sense. So we are strongly recommending to invest your short-term surpluses in accrual funds.
Okay.
Yeah, and that too if for medium term, so maybe about 2 to 3 years. Yeah, so for example, HDFC Corporate Opportunities Fund or ICICI Prudential Medium Term Fund. These are some of the debt funds where you should be considering your investment, and mainly in accrual funds.
So accrual funds are the preferred route.
That's right.
Any thought on any of these credit opportunity funds? Are you a fan of this particular category, or would you avoid?
Well, actually not. The credit opportunities has a lot to do with, the credentials of the credit rating agencies. Now, credit rating agencies have not done a great job, in India in last few years, because we have seen companies which were rated very high but still defaulted, very soon after that. So credit opportunities fund may not always work as per what the name suggests. We would rather suggest to stick to accrual funds.
Accrual funds are probably the best bet. Okay,
but another important aspect of investing in debt funds is that you must have your debt equity ratio very clear in your mind. And there are some thumb rules, but you can make your own rules as well. The thumb rules are 100 minus your age should be equity, and balance should be debt. So if you are 30 years of age today, I'm just making a guess, then 70% should be in equity and 30% should be in debt. Now this debt 30% could be a mixture of investments in capital protection oriented funds or the EPF account which you have with your employer. I'm sure wherever you're working, you must be getting a provident fund deduction and getting accumulated there, and the balance which you're keeping in your bank, like your savings bank account. All that put together shouldn't exceed 30%, but should not be less than also.
Okay, now Sanjiv, finally coming to the last asset class we're going to talk about today, and that's real estate. What's the first step towards planning for that dream house?
See, one of the first steps is that when you buy a home, you should buy a home to live in. Now, a lot of people buy a home to invest in, and they have no intention of living in it. So then you're taking an investment call. Then you have to look what is the investment return am I going to get, what is the rent, and as a rent, what is the percentage return I am going to get, and what is the kind of capital appreciation that I can have. So that's a pure play investment decision. Don't buy a house just for the sake of buying a house. But if you are going to buy a house which you are going to live in, then it's always the right time to buy. So I'm a huge fan of buying rather than renting if you're going to use it for yourself, because at the end of the day, after 15 years or 20 years, when you have paid off your EMIs, then you're going to be owning an asset.
But what's the thumb rule? How do you know what sort of a ticket size can you afford looking at your income? So is there a ratio that you can do? I mean, how do you go about knowing that you're not overstretching your realistic, financial profile?
So you have to look at the EMI, and you have to look at what is that percentage of EMI that you're willing to pay. So typically they say that you should be willing to invest about 20%. So if you are renting, your rent should not be more than 10% of your earnings. And your EMI should not be more than 20 to 25% of your earnings.
Because 30% is going in investment. That Mr. Chopra has already told us. So 30% of income is going towards investment.
Yeah, but that is after your take-home salary, which is after paying the EMI.
Yeah, so EMI and your rent are basically, these are, important things that you need to take care of. So, so for me, I'll say about 20 to 25% is comfortable. If you want to stretch yourself up to 35%. But no way go beyond 35%. So otherwise then you're going to be in deep
I'll also give
trouble.
you this answer. You asked what should be the ticket size of the property which you are planning to buy, looking at your current salary.
Looking at your income.
So generally the thumb rule is about 10 times. Or 8 to 10 times. So I'll just give you an example. If somebody is earning, say, 15 lakhs of rupees a year, then you should be looking at a property which is about 1 crore to 1.2 crores. Now it depends which city where he lives in. We know that in Mumbai, anything in that budget, is not possible. One has to go to Navi Mumbai or maybe little farther. But this is the thumb rule that one should be looking at. So about 8 to 10 times of your annual income is the kind of property which you can afford.
Okay, and finally, any tips in terms of when people are shopping around for home loans or something that, youngsters should keep in mind when they're looking at taking on the debt for the property purchase?
Don't just go shopping for lower interest rates, because there may be certain organizations.
And there are plenty of banks now lowering rates in the last couple of weeks. We've seen that.
Yes, but that should not be the only criterion, because there are some other hidden charges as well, which one should need to study in advance, and also look at what is the percentage of loan which you are getting. If the property is 100 rupees, whether you are getting 85 rupees or 70 rupees, and how long you are being allowed to repay. So obviously, if it is longer the period, say 15 or 20 years, your overall EMI would be less, and you would be able to allocate your funds to other investments in a much better way. So just don't look at only the interest rate, also look at the period, the EMI amount, and the other charges. And obviously the organization has to be of high reputation.
Absolutely. Well, gentlemen, thank you so much for sharing some of those hygiene thoughts with us. Hopefully that will help young working professionals set some of their personal finance issues in order. It's been a pleasure talking to you. Thank you for taking out the time, and thank you for being with us this week on Money, Money, Money. We'll see you again next week.